with the rise of artificial intelligence and other disruptive technologies, how do you evaluate the impact on potential investments without getting caught up in the hype and potentially being late to the party and overpaying for the investment?
Yeah, sure. So Schroders Capital actually has a pretty strong history in venture capital. We've been doing it for 28 years. So we've been invested in AI for a decade now. We've actually got investments in 3 of the top 4 large language models already in our ecosystem. So having that knowledge and that input into investment decision making is really powerful, because obviously AI started as, when you were looking at Spotify and it realized what music you liked and built an algorithm to fix that. And then I think everyone today is focused obviously on the sort of large language model of AI, the chat GPTs, the Grok and all those sort of solutions. So it's really great that we've had that learning, we've been through that journey, and we have a lot of those investments through our venture capital program. The fund that our buyout fund, which is predominantly what Australian investors would be familiar with, that doesn't do as much in venture capital, but we still have the benefit of that ecosystem and that team's knowledge. So if they're assessing a buyout company and think, if it's an accounting software, how is AI going to impact this? They can reach out to the venture capital team to test hypotheses, to make sure that that company is going to succeed regardless of the impact of AI. And we do actually have one AI adjacent investment in our semi-liquid fund, it's pretty cool. So it's when you think about the old gold panning days, you could get your pan and go off and pan for gold, but there was winners and losers in that. But who won? The people selling the picks and shovels. So what this company actually does is it annotates data and feeds it to the large language model, so it helps them improve the way they read and assess the information when then, you type in a question and it spits out an answer. Obviously, it's read swathes and swathes of text in seconds to give you an answer. So this company is really helping that data become more readable for the AI models. So its clients are Cohere, AI, Meta, NVIDIA, and it's selling its data to those, because we do worry a little bit that AI could be a bit of a winner-takes-all model like Google. And so I think if you're going to do venture capital properly in the AI space, you want to take a lot of small bets. So if it is a winner-take-all model, you've spread your bets thinly enough such that you can assess those, and that's what we do through our venture capital program. But as I said, this fund really focuses more on those profitable businesses, and you get a taste of AI, but without taking that kind of binary winner-takes-all risk.
Interesting, and it's exciting to hear and see some of the different applications for AI and the opportunities to invest, as you've pointed out, like all the way along the supply chain there and the different businesses that are partaking along the way. The other topic I wanted to raise with you is ESG. So environmental, social and governance factors are an increasing part of assessing investments.
Yep.
How does Schroders think about those and factor them in without narrowing down the investment universe too much, such that it puts at risk the potential return or increases the risk in the portfolio?
Yeah, so fortunately, private equity fits quite well within ESG because we focus on 5 key sectors: technology, healthcare, consumer is the one we have to be a little bit more careful, but business services and industrials. So, we tend to have very asset-light businesses, so we're not investing in mining companies, for example, or anything like that, where you have to think about more the environmental impacts. But ESG is built into our investment process. We have positive screens, negative screens, and ESG is considered as part of every investment proposal. The big one for private equity is obviously governance: who's running the company, what's their plan, and then we have limits within the companies we invest in on things like alcohol, gambling, and obviously we have strict exclusions as well on the real nasties. So we find that there's, we see hundreds and hundreds of private equity investment opportunities a year, and we do 100 transactions a year. So we find there's enough deal flow that we can still be selective on our ESG criteria and leave a good enough selection of companies behind.
Excellent. And one of the things that you're going to be talking our clients through tonight is the very large dispersion in returns between top quartile private equity managers and bottom quartile managers. And that's a real risk for private equity investors because you're typically tying up your capital for a long period of time. So you want to make sure you're in that top quartile rather than the bottom quartile.
Yep.
How do you at Schroders approach that and navigate that to be in more of the high performing vehicles than the underperforming vehicles.
Yeah. So we did some statistical analysis because the team, our private equity team, have been operating for sort of 28 years now. So a lot of anecdotal evidence around the fact that managers who have the thing about private equity investing is it's quite formulaic. You know, you find a good company, ideally you have private equity managers who are sector specialists and often regional specialists. They have a sort of playbook for how to grow the company, whether that's increasing sales, reducing cost, expansion, you know, whatever the sort of playbook is for that manager. And it tends to be a kind of rinse and repeat strategy where you find a good company, implement your playbook and grow it. And so managers who do that well tend to continue to do that well, and managers who haven't built the right playbook don't tend to consistently do it well. They might get the odd lucky stumble across the lucky company. But when we analysed this, so we did statistical regression analysis and we looked at top quartile managers and are they more inclined to be top quartile for their next vintages, or will they, you know, sort of drop to bottom quartile? And what we found is there is a statistical persistence. So if a manager's top quartile, they tend to continue to be top quartile. And if a manager's bottom quartile, it's very unlikely that they're going to come out of that bottom quartile of returns. So we overlay that. Important thing is to pick the right managers to begin with.
Yeah.
And part of that is making sure they have a clear edge in, you know, as I said, we like really, as our fun name suggests, we like specialist managers who are specialists often in sector, region. We want them to have a clear playbook of companies they're going to buy, what they're going to do to transform those companies, and when they're going to exit them. And then when we go to invest in a new fund of theirs, we look at all the deals they've done. We make sure they're true to that label of what they said they were going to do. Mm-hmm. If they deviate, if they start to move into larger size companies or different sectors, that's when we really start asking questions. But generally, if a manager is consistent in their playbook, they tend to continue to deliver pretty consistent returns. So yeah, rinse and repeat.
Right. So success breeds success, I guess.
Absolutely.
The better they are, the more they're going to attract the right opportunities and also the right talent to keep executing their process time after time.
Yep.
Thank you very much for joining us. I'm very much looking forward to hearing you share more of your insights with our clients this evening.
Great. Thanks, Andrew.
Thank you.